All right, thank you for joining us today. Today we have a topic about what entity type should I choose uh, at this current stage in my business. So today we'll talk about entity structure, entity type in business. So let me share my screen. All right. So here's the little thing about our firm. As you all may know, with more than 26 plus years of our firm's practice history, our firm and our team members, we speak 10 plus languages here collectively. We serve more than 10,000 clients worldwide. We have 4 branches currently. That's in Des Moines, Iowa City, Minneapolis, Capitola, California. So we are expanding again into our Houston branch here in June. So our CEO, Ying Sa, you guys see her all the time, has served on the National Taxpayer Advocacy Panel, which is a federal advisory committee that provides advice to the Internal Revenue Service on how to work with our taxpayers, people like you and people like me. And she has served on that panel at the highest level as a CPA. And we collectively, every day, every week, we want to provide the best knowledge that is accurate and informative to you. So she has 2 books, as you guys know. First book that's been around for a little while now is the 8 a.m. book, How to Start Your Business. And her second book is now out, Appointment with Ying at 10 a.m., which is How to Grow Your Business. So whether you're starting your business or growing your business, you want to pick these books up either at one of our locations or on Amazon, and feel free to pick that up and read it. We have clients that tell us they've never read a book cover to cover, and they've picked this book up and they've read it cover to cover because it's story driven. And if you heard Ying talk, you know she's a great speaker. She's a good storyteller. So her books are just like that, and filled with real stories with different names, right? And so you can relate and you can implement into your practice, into your business, in whichever stage you're at in starting up your business or growing your business. So I have to read this no responsibility disclaimer. So you guys are familiar with that. Community CPA are providing these seminars in order to disseminate knowledge that may help businesses like yours to grow, and you can learn at your own leisure. We are not responsible for any damage the attendees may suffer as a result of following any advice or information here provided. Although we are doing our very best to stay informed, the information always changes and can become obsolete at any time without any notice. So please keep in mind. And I'm going to kind of talk a little bit about our YouTube channel. And I always tell people, make sure when you go and search for our YouTube and our videos, you look at when it was posted. The more recent, the better. And so that you know you're getting the most up-to-date information. Keep that in mind. Now, let's jump right in to our entity talk. You know, we had the sole proprietorship businesses. They're equivalent to a Schedule C. Another type of Schedule C is a formal single member LLC. As far as the tax, they're treated the same. There's also the partnership, the multi-member LLC, S corporation, C corporation. Well, what do they all mean? Today, we will learn that. So, when is it right for me to be a sole proprietorship? So first you have to know you're automatically a sole proprietor if you conduct business but don't register with the state, particularly the Secretary of State, as any kind of business. So if you didn't register, don't worry. You're conducting business activities. Don't worry. You're already a business. Whether you like it or not, you're a sole proprietor. So sole proprietorship is yourself. It's you. And it's not any separate business entity. So you know that when you're operating as a sole proprietor, you're using your social security number, right? So sole proprietor's tax return is reported on your personal tax return, okay? On what's called the 1040 Schedule C. As a separate EIN is not required for a sole proprietor, you could always apply for one later if you're needing a separate tax ID, okay? But there's a lot of risk here, okay? There's a lot of risk because you yourself are personally liable for any debts, obligations that the business will have, okay? So just kind of keep that in mind. Next, we have the pros and cons of Schedule C. The pros are it's easy to set up. The cons, high liability risk, okay? You're personally liable. You can't get higher than that. Then there's the owner maintaining 100% control of the ownership of the business. So that's a pro, right? And its con is that there's some solvency issues with the bank, okay? Another pro is there's no double taxation, okay? A con is you really have no room to grow. Okay? Can't add partners. You can't elect your business to be a different entity type, which we'll talk about briefly later. And another pro is only one tax return. That's it. You don't have to file a separate business tax return like you would in a partnership, in an S corporation, in a C corporation, okay? A con is self-employment tax. So there's 15% additional self-employment tax you have to pay. Can't get away from that, okay? So continuing the talk of single member LLC and sole proprietorship and how it's treated as a 1040 Schedule C, an LLC owned by one person, like I mentioned, is no different from sole proprietorship when it comes to taxes, as it forms and files a 1040 Schedule C in your personal tax return, okay? Partnerships, on the other hand, I want you to know is a simplest structure for two or more people to own a business together, okay? There are two kinds. There's the limited partnerships and there's the limited liability partnerships, okay? An LLC can have unlimited number of members. An LLC's members may include individuals, corporations, other LLCs, or foreign entities. So there's a lot of flexibility there. 1065 is a tax form that you would use to report your income, your losses, deductions, credits, all sorts of different activities that you have in a business. This is the form you will use to file your taxes. Unlike the 1040. Remember 1040? 1040 is your personal tax return form. 1065 is your partnership LLC tax return form. So just remember that, okay? So when should I file? As an S corporation. So to know that, you need to know the 1120S is an income tax return for S corporation, and this is where you report your income losses and dividends to its shareholders. Remember, partnership is 1065. 1120S is where you would file for your S corp. S corp is a loophole created for a lot of the small businesses, and it is not something that you could get right away by applying for an EIN. Rather, it is something that you need to elect. We'll talk a little bit about that, okay? Here you see that the date you elect the S corp is really important because sometimes you can change your entity to be an S corp after you first started as a C corp. So it can get kind of messy here. If you, let's say, started your C corp, which is the basis of everything, that's how you start, okay? And then let's say you started that entity and you said that the beginning date will be May. Okay. And then let's say you applied for your S Corp and you weren't paying attention to the application, and then you put the date that you are applying, let's say in November. Then you might even have to file a short year for your C Corp leading up to November, because November is when IRS will say that's your beginning date. That's your beginning month of S Corp filing. So everything before November, you're going to need to file separately as a C Corp, and then after that as an S Corp. So just be careful with your application. Consult a professional to get that filed correctly. It's important, that beginning date of S Corp status. That's all done using this form called 2553. It's the election form to become an S Corp. Okay. There are things to know. For eligibility, you can't have more than 100 shareholders. Remember, I said this was a loophole created for small businesses, right? So generally, small businesses don't have more than 100 shareholders. Those are more like C corporations, like the Walmarts, and the Apples, and the, Wells Fargo's of the companies out there, right? And there's only one stock that can be issued, one class of stock that could be issued rather, and shareholders are individuals. Can't be non-resident aliens and certain trusts or estates. So just kind of keep that in mind. Let's talk about the pros and cons though here. Pros, I'm just gonna read them, go down the line here. So potential tax savings are there. Remember I said with a Schedule C as a sole proprietor, as a single member LLC, you pay self-employment tax. So S Corp doesn't. Okay, just remember that. And it also doesn't have to pay taxes like a corporation, meaning like a C corporation. Instead, individual shareholders can report their earnings on their individual tax returns. So if you have a loss, you can potentially get that back on your personal tax return. And because the S corporation is not taxed at the corporate level, S Corp can result in significant tax savings for its shareholders. Personal assets and business ones they're all separate when it comes to business liability. So you have protection, right? So when you have your business filing its own tax return and separately from your personal, that already gives you more protection. So kind of keep that in mind. It's easy to transfer ownership. If you decide to give your company to a relative or sell it to another owner, it's easy to do so as an S Corp. But there are some cons. S Corp is more regulated, okay? So meaning it's less flexible, okay? Tax obligations, again, more regulated. If you make simple mistakes with your tax, you could lose your S Corp status, okay? And IRS pays more attention to S Corps, because they're more typically for the small businesses. And a lot of our small businesses, right, they don't want to pay an arms and a leg, right, for taxes to be done. So the IRS may feel that you're filing it maybe by yourself or with an agency with not much credibility, and that's really why there's a lot more attention to S corporations. Keep that in mind. And one last thing, it could be a benefit. If you're going to run a payroll, you have a payroll requirement, doesn't really hurt you. But let's say you don't plan to run payroll, But if you're an S Corp, you need to have it. Okay, just kind of keep that in mind. Now, on to C Corps. A C corporation is a business entity that is taxed separately completely. Remember, S corporation is taxed separately. It's filing taxes separately, but it doesn't pay its own taxes. Remember, I said everything flows down to where? Your personal taxes. So there you'll be filing your taxes, paying for taxes, or even getting a refund. But C Corp, everything is done in the business. Everything is done completely separate from your personal. So they report their taxes, they pay their taxes. If you have a loss, they retain those losses for offsetting the future income. Okay. So there's also a chance of double taxation if corporate income is distributed to business owners as dividends, which are also considered personal income. So keep that in mind, but there's a lot of benefit there. And we'll talk a little bit about the pros and cons for C Corps as well. But tax on corporate income is paid first at the corporate level, and again, at the individual level on dividends. If you choose to issue, you don't need to issue it, okay? It's not required. It's up to you if you're an owner of a C Corp. Just keep that in mind. So, note here, C Corp can become an S Corp through an election. We talked about that. But also, you can also choose to give up your S Corp status and become a C Corp too. Works both ways. Remember, we talked about LLC. LLCs can also elect to become a C Corp or elect to become an S Corp. But just remember, you cannot elect every year because IRS only allows you to do that every 5 years. 5 years is the magic number you want to keep in mind. And every 5 years, that's really when you're able to elect. Now, let's talk about the pros and cons. C corporations have a lot of pros, and those pros are that the owners can completely separate themselves individually from the business. You know, you hear Donald Trump filing bankruptcy and he's having everything completely separate, files bankruptcies on those businesses that are not personally liable. Doesn't affect his person. Why? Because C Corp is the most mature state of a business entity. It's its own person. So it gives you the best protection. You can sell your stock, you can raise the likelihood of acquiring financial capital. There's a lot of flexibility there with the C Corp. And it's very well established structure with very clear roles and accountabilities and agendas. Employees may have the option to buy stock at a fixed price and receive stock benefits. So, what are the cons? There's some paperwork involved with a C Corp. So because it is a more matured entity type, you want to make sure you have all the meeting notes properly. You want to make sure that, you know, you have a lot of the paperwork taken care of. Every decision you make, you want to make sure you account for that. But when you're in business, we always recommend that anyway. There's some regulations involved. And in some sense, some less flexibility. And again, that double taxation, we were talking about that earlier. Something here that's not mentioned here on the pros that kind of counteracts the cons is that if you are a owner of a C corporation, remember C stands for capitalism, right? So if we mention those big corporation names like Apple, Walmart, Wells Fargo, what do they have? A benefits package. For who? the executives, the capitalists, the people at the top. So, if you choose that the corporation that you happen to own the majority shareholders for, you can put together a nice benefit package for yourself and have the board approve it. Okay. With that being said, you really have a lot to work with there. Okay. So your personal side of things are taken care of. As long as the business sees the benefit of you having those benefits so that the business can be ran better. Okay. And that could cause those things to be approved by your board. Okay. That is about our entities. So we talked about the different kinds of entity types, right? So we have the sole proprietors. Okay. Then we have the LLCs. That could be a single member LLC or a multi-member LLC. And then we have the S Corps, and then we have the C Corps. So if you think about these entity types, the way in which I explained these entity types, from all the way to sole proprietor to C corporation, it is a growth chart, a company growth chart, a business growth cycle. And just know that when you're first starting your business and you want to test out the waters and you're just not sure this business is going to fly, it's okay to have it as a sole prop. But as soon as you have some risk, you want to continue on with the business and you want to grow your business, you want to have some protection, like an LLC. Okay. And then once you make a lot of profit, okay, and you want to make sure that you pay a little less taxes and do away with the self-employment tax and start running payroll, guess what? Now you need an S Corp. Okay. Once you have more than 100 shareholders investing in your business, maybe even less than that, and you feel that your profit really makes sense to be a C Corp, your accountant will tell you, your tax preparer will tell you, we can tell you, and we'll make you a C Corp with a nice benefit package because you work so hard and you deserve it. So those are the entity types you want to kind of keep in mind when in business. And those are the different entity types you can change to, you can elect to when you are ready. If you would like to know more and you like to do a consultation with any of our partners here, okay, feel free to book an appointment with us. We'd love to help. Okay, you can find us and find this same group of people in our list by going to our website, www.communitycpa.com. Click appointments, and we can talk to you more about that. Now, we really appreciate your time today, tuning in to Community CPA webinars. And we thank you. We've been doing this since the day after COVID started because we just wanted to share our knowledge and grow with you, learn with you, and make sure that you are informed and you're continuing to grow in your business journey. So thank you for choosing Community CPA if you're our clients. If you're not yet our client, we'd like to see you and we'd like to meet you so we can make a difference in your business. You can do so by going to our website again, www.communitycpa.com. And there's an onboarding link there you can click to onboard with us. And me or Catherine at our firm will reach out. We'll talk about how we can work together. So We look forward to working with you, and we appreciate your business. Have a good rest of your day. Thank you.